What is the reason we study finance? Most people in one way or another are interested in money, want to scale socially, improve their quality of life and give their children better opportunities. That is why the more you know about finance, the more knowledge you will have to make efficient use of your resources. The field of finance is intimately linked with two ancient disciplines such as economics and accounting. The economy provides knowledge for risk analysis, price theory based on supply and demand, and the company relation with banks, consumers, capital markets, the central bank, and other economic agents. Objective of finance. Finance represents that branch of economy science that deal with everything concerning value. They deal with how to make the best decision to increase shareholder wealth, that is the value of their share. The goal of finance is to maximize shareholder wealth in this way. Investment decision and financing decision must add as much value to the company as possible. The financial executive must ultimately deal with efficiently allocating resources and guiding all his decisions to increase the value of shareholder wealth. The concept of maximizing value immediately generates a question. How do we measure whether the company creates or destroys value? This point will be treated in detail, but we want to make an important distinction. Generating profit is not necessarily the same as maximizing value. While profit and value can often be linked, it is not any profit that maximizing value. Since profit often generates mirage that lead to misallocation of resources and destruction of wealth. Of course, in the capital markets environment, investors are looking to maximize their profits when they buy the security that the company issues. So does a portfolio manager when looking for a better mix of risk and performance. Why objective should not be maximizing profits? There are two main reasons for not using profits. Maximization has an operational objective. First, the term profits means different things depending on the case. Managers often refer to some measure of accounting earnings. There are a lot of them and are based on book values, while stock market traders talk about gains based on market values. In addition, these are affected by accounting convention. Maximizing shareholder wealth is also good for all economic agents. For example, accepting a project whose performance is less than the cost of resources to carry it out has a more serious consequence than just eroding shareholder wealth. Assigning capital inefficiently is the greatest sign the finance executive can commit. If this happens intentionally or not, grow and standard of living decrease for all the people involved. Earning in which the finance executive, although the financial executive can perform in several areas, we can distinguish three well-defined: corporate finance, financial investment, capital market, although three use the same principles and involve the same financial transaction. They deal with them from different points of view. For example, within the sphere of corporate finance, the financial executive manages own funds, and in the field of financial investment and the capital market, manage funds to third parties.
The value principle of good idea. New products or services can create value, so if you have the imagination for a good idea, this could become an excellent return. Most good ideas tend to physical assets market, since unlike financial assets have more chance of being unique. The principle of comparative advantage. This all principle simply tells us that we must dedicate ourselves to producing what we have a comparative advantage in, that is, in which we are more efficient because we can produce it at a relative lower cost. The principle of the value of the option. The real option technique has been designed to capture the flexibility that the entrepreneur has when he is in a company and can make changes. We must think of the option as right, not an obligation. The principle of incremental benefits. This principle tells us that we wish choose a certain alternative, we must do it for its extra benefits. This is incremental compared to the alternative of not doing so. In finance, generally, these are incremental cash flows. Economic status or results. The income statement represents the whole calculation of the loss and the profits that from the companies organized in the form of corporation until the one-man operation have lasted for years. The operating result of the company. It is undoubtedly the most important category of result in a company. The operation of the company involves a series of costs and expenses to obtain the field result. Operating costs. Selling goods or services generates costs. The first on that appears in the income statement is the cost of the goods sold, CMB. It represents, as its name indicates, the cost of goods that has been sold. The CMB is decided in annex to the financial statements and usually constants salaries, social charges, materials, rents, fuels and lubricants, depreciation of fixed assets used in the production process, installation expenses, fees, insurance, and others. ABET immediately following ABET operation result shows a series of the items that represent the effects of financing, other income and expenses, and sometimes extraordinary results that are as following. Financial results normally divide into liabilities and generate B assets. Both comprise in mild interest, exchange difference, price difference, holding results, and inflation adjustment. Other income and expenses. These are those income or expenses that do not have a specific classification weighting, which we have seen as administrative, commercial, or financial expenses. Extraordinary income. This refers to extraordinary income or expenses such as the sale of a fixed asset, compensation for personnel claims, corporate income tax. Finally, if the company shows profit after all the items have been paid, it must pay corporate tax. The notes to the income statements and the annex. The notes and the financial results annex clarify the composition of the item from a more delayed opening. The balance. The balance sheet reports the equity position of a firm at a given time. Normally, the balance sheets are represented on an annual basis, and in the case of the companies listed, on a quarterly basis. It is examined for the general to the particular, for in which we must approach to financial statements. The active assets are where all the assets and rights owned by the company are collected. That is what they have and what they want. The liability. The liability shows use how the company finances its investment and represents two types of the rights over assets, liabilities, and own capital.
Preferred shares. This type of shares confers on its containers certain privileges on those holding common shares, which are established in their issuance conditions. Preferred stock is a financial product rather than equities, and debt serves to raise funds, so that any investor can acquire them. Retained earnings. The firm retains earnings in three ways: reserves, undistributed profits, or when it dividends into shares. The balance of retained earnings reflects a kind of current account of the company over time. It grows if the company saves reinvesting in itself and decreases if it pays cash dividends. Working capital. From an accounting standpoint, working capital is defined as the difference between current assets and short-term liabilities. However, working capital is far from static. On the contrary, it constantly changes. Since the sales are generated on a permanent basis, and with them the accounts receivable and the purchase of inventories with the consequent accounts payable. The size of working capital depends on the cash cycle, i.e. the time between the time the money leaves to pay the inventories until the sales are charged. The financial statements contain historical information. The report of the firm's financial statements is still the document that best summarizes the financial activities of the firm and the first request from banking analysts. consultants and researchers when looking to analyze the economic financial situation of the company. However, this information is hardly a starting point, and for good reasons. Many times they do not provide critical information for decision-making, and as we shall see, financial statements may have major limitations in communicating this situation. One of the fundamental discrepancies lies in the disparity between book values and market values. This is particularly important in the case of fixed assets. But there may also be important differences in other cases, as will be noted below. Tangible fixed assets, valuation and liquidity. Fixed assets can be of two types, tangible and intangible. Imagine that you start a business for which you acquire certain tangible fixed assets, a plant, wheels, and machinery. These assets are recorded on the balance sheet at historical cost. Tangible fixed assets generally generate large transaction costs when they are sold, but the sale process is more complicated than selling inventories, takes longer and has less certainty. Inventories. FIFO versus LIFO. The final existence of the assets of change in the balance is usually a conflict item. Since there are several methods of valuation, FIFO, LIFO, also a weighted average. This has its corresponding impact on the cost of goods sold. The FIFO method would cause the final stocks to be valued at the last prices, reducing the CMV and increasing the profit. The serious disadvantage would be that it would pay more taxes. With the LIFO method, the exact opposite would occur, since the final stocks would be valued at the first prices. Inflation. Every time inflation shows its horrible head, and the South American countries have lived for long periods with it, began the complications to show the real results and the financial position of the company. Due to the fact that in the financial statements operations are recorded in monetary units on the dates they are performed, there are added currencies with different purchasing power. Inflation distorts both the balance sheet items and the income statement. The greater distortion occurs in fixed assets. Tax planning. It is understood by tax planning the use of appropriate legal figures in order to diminish the positive impact. Tax planning is especially relevant in terms of choosing the financing chosen and the legal structure of the business. Tax planning represents a legal financial structuring with the objective of reducing the payment of company taxes and creating shareholder value. Average rate and marginal rate in corporate tax. This point will focus on the income tax, since it is the most widespread income taxation in Latin America. In a progressive tax system, the marginal rate is always higher than the average rate. The average rate increases as the company's revenues increase, and these are taxed at high marginal rates. Differences between the balance sheet and the fiscal balance. The differences between the fiscal balance and the accountant, always depending on the tax legislation in each country, can be classified basically as temporary and permanent or permanent. Some examples of differences would be transitional differences, *, accelerated depreciation of fixed assets, *, differences in valuation criteria, for example, inventories, real estate. Intangibles, *, tax limitations on the calculation of expenses, for example, inability to deduct charges for services to related companies until their actual payment. Permanent differences, *, exemptions or deductions, *, limitations on deduction of expenses, *, differences in the attribution of results to an exercise, *, certain foreign source income, which does not tax the local tax.